Welcome back to the deep dive. All right, today we're tackling something really foundational, your first credit card.
Yeah, it's a big moment. Feels like real financial adulthood kicking in.
Totally. It's convenient, sure, but it's also, the start of building your credit history for everything later on. Renting, maybe a mortgage.
Exactly. And look, the financial world doesn't really give you practice runs, does it? So
Mhm.
our mission here is to give you a shortcut. We've dug into the common mistakes, the key things that actually build your score.
And how do you even get started if you have like zero credit history right now?
Right. So you can skip the common pitfalls and really make that first card work for you, not against you.
Okay, let's get into it. The engine behind all this is your credit score, usually the FICO score. It kind of dictates your financial future in a lot of ways.
It really does. Access to loans, interest rates, it all ties back.
So if you remember nothing else, there are two really big pieces that make up most of that score. What's number one? The absolute must-do.
Without a doubt, it's payment history. That accounts for a massive 35% of your FICO score.
35%. Wow.
Yep. Nothing else you do matters much if you mess this one up. Paying on time is non-negotiable.
Okay, but let's clarify something important for beginners. Is being a few days late the same as truly missing a payment in the eyes of the credit bureaus?
Great question. No, they're different. If you're, say, 5 days late, you'll probably get hit with a late fee from the card company, maybe some interest charges, but it likely won't show up on your credit report.
Okay, so that's annoying, but not catastrophic.
Right. The real damage happens when a payment is 30 days or more past the due date. That's when it flips from just late to officially missed.
And that's when the issuer reports it to the credit bureau.
Exactly. And that's where the hammer falls on your score.
It feels, I don't know, really harsh for just one slip up, especially when you're just learning. Why is that one 30-day miss so damaging?
Well, harsh maybe, but from a lender's view, your track record of paying bills is the best predictor of whether you'll pay them back in the future.
Okay. Reliability.
Yeah.
Okay.
If you can't handle, a small payment on time now, why would they trust you with a big loan later? That single missed payment can potentially drop your score by up to 100 points.
100 points for one mistake.
It can, yeah. And that immediately means higher interest rates, maybe getting denied for loans or apartments later. It's a big red flag for lenders. High risk.
Okay, so prevention is absolutely critical. What are the practical ways to make sure you never hit that 30-day mark?
Automate, automate, automate. Set up auto pay. Even if it's just for the minimum payment, you can always pay more manually, but that safety net is crucial.
Good point. Covers your bases.
Definitely. Also, set reminders. Your phone, calendar alerts, text, or email alerts from the card issuer itself. Use them.
And I heard a good tip about due dates.
Oh yeah, that's a smart one. Call your credit card company. You can usually ask them to change your payment due date to line up better with when you get paid.
So if you get paid on the 15th, maybe set the due date for the 20th.
Exactly. It just removes that potential cash flow crunch or, the chance of simply forgetting when the money isn't quite there yet.
Okay, so payment history is 35%. Huge. What's the next biggest piece of the puzzle? This is where it gets a bit more strategic, right?
It does. This is credit utilization ratio, or CUR. It accounts for 30% of your FICO score, so almost as important as paying on time.
30%? Okay, what exactly is utilization?
It's basically the amount of revolving credit you're using compared to your total available credit limit.
Revolving credit meaning like credit cards mainly.
Yes, primarily credit cards,
Yeah.
not installment loans like car payments or mortgages. So, simple math. If your credit limit is $5,000 and you spent $500, your utilization is 10%.
Okay, 10%. And we always hear that keep it below 30% rule. Is that the magic number?
30% is. Let's call it the minimum passing grade. If you stay below 30%, you'll generally build a decent score.
Yeah.
Shows you're not maxing things out.
But decent isn't necessarily great.
Exactly. To really get into the excellent credit range, the 800-plus scores that unlock the very best rates and offers, those folks typically keep their utilization much lower.
How low are we talking?
We often see people with top-tier scores keeping their overall utilization around 7%, maybe even a bit lower.
Wow, 7%. So 30% is like, okay, you're managing. 7% is like you're acing the test.
That's a good way to put it.
Yeah.
And understanding that helps bust a common myth. The idea that 0% utilization is the absolute best.
Right, because if low is good, 0 must be perfect.
You'd think so, wouldn't you? But if you never use the card, or carry a zero balance constantly for months on end, lenders don't see any evidence that you can actually manage revolving debt responsibly.
No data for them.
Precisely. We've actually seen scores sometimes level off or even dip a tiny bit if cards just sit completely unused for too long. The sweet spot seems to be using the card lightly, keeping that utilization very low, definitely single digits if possible, and then paying the balance in full every month.
And this utilization thing, it's not just about one card, is it?
No, good point. Lenders look at two things: the utilization on each individual card and your overall utilization across all your revolving accounts combined.
So you could have one card near its limit, and even if your others are empty, that one high utilization card could still hurt you.
It could, yeah. They look at both the specific card and the big picture. Best practice is to keep utilization low on every card and overall.
Okay, so payment history and utilization, those are the big levers. Let's talk about the ways people accidentally, trip themselves up, especially when they're new to this. What are the common pitfalls?
Yeah, the fatal flaws. Number one is probably forgetting that a credit limit isn't extra money. It's debt. We call it the overextending or free money myth.
Ah, I can see that happening. You get a $2,000 limit and suddenly feel richer.
Exactly. Someone buys, say, a new gadget for $1,200, thinking, oh, I'll pay it off over a couple of months. But if they don't pay the entire balance by the due date,
Interest charges kick in.
right, that annual percentage rate, the APR, suddenly that $1,200 gadget costs them maybe $1,300 or more just because they carried a balance. You're paying for the privilege of borrowing.
Which leads directly to the next mistake, I guess.
It does. Flaw number two is lack of budgeting. If you're spending more on the card than you can actually afford to pay back in full each month, you get into trouble fast.
The interest piles up.
And your utilization ratio shoots up, which, as we just discussed, hurts your score. You absolutely need a budget to know what you can safely charge and pay off. Treat the credit limit as less than what's in your bank account, not more.
Makes sense. What's the third common mistake?
This one happens before you even get the card. Choosing the wrong card.
How so? Aren't they all pretty similar at the start?
Not really. You need to look closely at a few key things. Is there an annual fee? What's the interest rate, the APR? And what kind of rewards or benefits does it offer, if any?
Right, like getting a fancy travel card with airport lounge access.
When you only fly once every few years and pay a $95 annual fee for it, that's just wasteful. You'd be much better off with a simple no-fee card that gives you maybe 1.5% or 2% cash back on everything, or maybe extra on groceries if that's where you spend.
So match the card to your actual life and spending habits?
Yes. Don't chase rewards you won't realistically use.
Okay, and the final flaw?
This one's about leaving value on the table, not using the benefits that often come with the card, even no-fee cards.
What kind of benefits are we talking about? I thought it was mostly just points or miles.
Oh, there can be some really useful ones people just don't know about. Things like extended product warranties. The card might add an extra year of warranty coverage to electronics or appliances you buy with it.
Really? That's actually pretty good.
Yeah. Or another big one is the auto rental collision damage waiver, CDW.
Ah, the rental car companies always try to sell you.
Exactly. If your card offers primary CDW coverage, you can often decline the rental company's expensive daily insurance fee, maybe saving $15, $20 a day, because your card already covers theft or collision damage to the rental.
Wow. Okay, so it pays to actually read that little benefits guide they send you.
It really does. You might be surprised what perks are hiding in there.
All right, this is all great if you have a card. But what about someone starting from absolute zero, no credit history, that thin file we hear about? How do they even get their foot in the door if they can't qualify for a regular card?
That's a common hurdle. The most straightforward path for someone with no credit is usually the secured credit card.
Secured, meaning you have to provide some security.
Exactly. You give the bank a cash deposit, typically maybe $200, sometimes $500 or more. That deposit becomes your credit limit.
Ah, so if I deposit $300, my limit is $300.
Right. And because the bank is holding your cash as collateral, their risk is basically zero. That makes it much easier to get approved, even with no history.
Then you just use it like a normal credit card.
Yep. Make small purchases. Pay the bill on time. Keep the utilization low. Do that responsibly for, say, 6 months to a year. And many issuers will then graduate you.
Graduate.
Meaning they'll convert the card to a regular unsecured card and they'll refund your original deposit. You've proven you can handle credit.
Okay, that sounds like a solid plan. But hang on. If I have $300 or $500 cash to put down as a deposit, why wouldn't I just use my debit card for purchases and avoid the whole credit card thing for now?
That is a perfectly logical question. The key difference is reporting. Your debit card usage, spending your own money, doesn't get reported to the credit bureaus.
Ah, so it doesn't build any credit history.
Correct. A secured card, even though it's backed by your deposit, functions like real credit. Your payment history and utilization are reported. It forces you to demonstrate you can manage that revolving credit concept, borrowing and repaying. That's the proof lenders need to see to eventually give you unsecured credit.
Got it. So the secured card is specifically for building that track record. Are there other starting points?
Yes. If you're a student enrolled in college or even a trade school, look into student credit cards.
How are they different?
They're typically unsecured, meaning no deposit needed, but they're designed specifically for students who likely have limited or no credit history. The limits might be lower, maybe the APR is a bit higher, but they're accessible and often have rewards geared towards student spending, like cash back on streaming services or food.
Anything to watch out for with student cards?
Yeah, if you're under 21, federal rules usually require you to show proof of independent income, or you might need a cosigner, like a parent.
Okay. And you mentioned something about a non-card option, too. That helps with the credit mix.
Right. Diversifying your credit types is also good for your score long term. This is where a credit builder loan can be useful.
Loan. So you get money up front.
Actually, no, it works kind of in reverse. You apply for a small loan amount, say $500 or $1,000. The bank holds that money. You then make fixed monthly payments to the bank over a set period, maybe 6 to 24 months.
So I'm paying them for money they already have.
Essentially, yes. But the crucial part is that those on-time payments are reported to the credit bureaus each month, building your installment credit history. Once you've made all the payments, the bank gives you the original loan amount, often minus some small interest or fees.
So it's like forced savings that also builds credit.
Pretty much. And some research has shown that for people with no existing debt, using a credit builder loan alongside, say, a secured card can actually boost their score faster than just using a card alone, because it establishes both revolving and installment credit history.
Interesting. Okay, one more strategy people talk about. Using someone else's good credit to help you start. Co-signing versus being an authorized user. What's the real difference? It sounds confusing.
It can be. And the distinction is critical, mostly about legal responsibility. Let's take cosigner first.
Okay.
If someone cosigns a credit card application with you, they're applying jointly. They're 100% legally on the hook for the debt if you don't pay.
So if I default, the bank goes after my cosigner.
Absolutely. Full stop. Because of that huge risk for the cosigner, honestly, most major credit card companies don't even allow cosigners on new card applications anymore. It's becoming pretty rare for cards.
Okay, so co-signing is probably not the main option for most people starting out with cards. What about being an authorized user?
Right. This is much more common. An authorized user, or AU, is someone the primary cardholder adds to their existing account. The AU gets their own card with their name on it linked to that account.
But they aren't legally responsible.
Correct. The primary account holder remains 100% responsible for all the charges, the interest, the fees, everything. The AU has no legal obligation to pay the bill.
So why would being an AU help my credit if I'm not responsible?
Oh, this is the magic, sort of.
Yeah.
When you become an AU on an account that's in good standing, meaning it has a long history of on-time payments and a low utilization ratio, that positive history often gets added to your credit report.
So I instantly inherit their good track record.
In many cases, yes. You benefit from their potentially long payment history, and, importantly, their high credit limit gets factored into your overall available credit.
Which would immediately lower my personal credit utilization ratio.
Exactly. If you have little or no credit yourself, suddenly having access to, say, a $10,000 limit from the primary user's card makes your own utilization look much better, even if you never actually use the AU card. It can give your score a really quick boost. And there's usually no credit check required for you to be added as an AU.
That sounds almost too good to be true. Fast track to good credit. What's the catch for the authorized user? If I'm not legally liable, where's the risk to me?
The risk is that the primary user's actions still affect your credit report. While you don't have to pay the bill if the primary cardholder suddenly runs up a huge balance.
Oh, their high utilization hits my report too.
Yes. If they max out the card, your score can take a nosedive because that high utilization is now associated with you. Same goes if they start missing payments, though some bureaus might handle reporting of negative payment history for AUS differently. The high balance definitely impacts your score.
So you absolutely have to trust the primary person to manage the account responsibly.
100%. You're hitching your credit wagon to their financial habits, good or bad. Choose your primary cardholder very, very wisely. So if we boil down everything we've covered today, building good credit really comes down to two main things: consistency and moderation.
Consistency in what?
Consistency in paying your bills on time.
Uh,
Every single time. No exceptions. That's the foundation.
Moderation.
Moderation in how much of your available credit you use. Keeping that utilization ratio low, ideally in the single digits, below 10% if you can manage it.
Right. It's not about fancy tricks, just responsible habits over time.
Mm.
Remember, that first credit card, it's really just the first chapter in a long financial story you're writing.
Well said. Treat it like a tool to prove you're reliable, not just extra spending power, and you'll be setting yourself up well.
Okay, so here's something to think about as we wrap up. We know the scoring models like to see that you can handle different types of credit, what they call the credit mix. That means both revolving credit, like cards, and installment credit, like loans.
Yeah, diversity helps.
So for someone just starting out, could it actually be beneficial to use multiple tools right from the beginning, like maybe getting a secured card and taking out a small credit builder loan at the same time? Could tackling both types of credit simultaneously actually accelerate your journey to a really strong financial profile? Something to consider. Thanks for diving deep with us today.